I'm using a very, very low latency. I'm using the lowest settings on live streaming. I can't make it get to you any faster. I'm telling you before it happens when there's only 3 to 4 seconds delay. So there's absolutely no bullshit fluff in here. I'm telling you what's going to happen before it happens. What is important, what's not important. If we can discern where the market's likely to go, and we can time it, and we can also build some framework around if it's viable, if it's a good trade. We're going to talk about that next week. That's the main takeaways for next week's focus is what are problem things in price action that is going to be important to see, but you're not going to master that soon. It won't be a fast, like, oh, I understand because I watched that part of the lectures. No, it's going to familiarize yourself with the things that are problematic. So when I'm watching price action, when the market's clean, it's easy, like up, down, all around, buy it, sell it all day long. But when we are in a week like this week, which is what I opened up with on Monday, some of you probably forgot or didn't listen to me, when I mentioned that we are in the week with Jackson Hole Symposium. So Jackson Hole Symposium, let me get this line off here because this is now that. Okay, so that's the opening range low. And then we are trading at 10 o'clock. One more. 30 seconds will be at the end of the opening range. So then by that, you know you have the low, and whatever the highest high is, that's your opening range for the day. And you want to do quadrants on that and extend that throughout the entirety of the day. And if you have a macro overlap with that, with time, chances are you have a trade, as long as you know what side of the liquidity you're going to aim for. And I just gave you something that I've never taught that anywhere. Okay, so that's algorithmic. Don't take my word for it. You'll be able to rewind it when you get the recording done. But right now, just pay attention. It's important for you to listen to it twice, because I promise you, if you watch these lectures and you just listen to them one time, you've missed something. And chances are you've missed something really important. Like I mentioned on Monday, I said Jackson Hole Symposium. Day one was Wednesday, or no, day one is today. And Friday's day 2, and then Saturday's day 3. We don't give a shit about Saturday because we're not trading on it. But the week that has Jackson Hole Symposium, and the way you determine that is you simply look at the economic calendar. And it's usually one time a year. And the week that it occurs, that full calendar week, I don't know why it does this, okay? This is something that I've observed over the years, and I kind of prepare myself for it. I mentioned on Monday that this particular week has a tendency to see price have overlapping price swings, which invites what for a market profile? It invites the seek and destroy. It invites the likelihood of, if you don't have a partial taken, chances are you can be stopped out and have nothing to show for it. Even with like a 75, 100 handle run, it can come all the way back against you and then run again in the same direction, or go back and forth and just chop back and forth. But Jackson Hole Symposium week, always, and you need to have this in your journal, and I still am seeing comments like, I'm having a real hard time. It's been real messy this week. Can you talk about that? I did before the week started trading. I told you that was going to happen. So what I do in my trading, and I'll show you an example of it here in a little bit when I walk through yesterday's trades. I had a lot of people saying, can you tell me what you were doing there? Why was you trading at that time? It wasn't the aspect of the time of entry. It was what I was seeing that I'll articulate it when I get there. So we went above, and now right below this low, we have initial sell side and buy side is here. So there's inefficiency between the low of the opening range, not opening range gap. We're inside the opening range gap, which is that blue shaded area. But we have sell side here and inefficiency down to previous settlement. So this is the part that's still not that open to inefficiency. So this part is the remaining portion that's lacking any buying and selling during the regular hours. It doesn't matter that we traded here in electronic trading or pre-session. It doesn't matter. Always give the opportunity for the day session, which is 9:30 to 4:15, to reprice into this area, both sides. Since there's no trading between the settlement price and this candle's low, there's no buying and selling booked at all, zero. I'm not saying there hasn't been, because clearly if we go to electronic trading, you can see that we did trade through it. See that? So it's lacking what? Sell side. Now, here's a big paradigm shift. Since we passed up through it here, it's lacking sell side. So what kind of price delivery, if it wants to go back to the settlement price of yesterday, if it goes below this low, what type of price action would you like to see? What would be the type of price delivery that you would like to see? If it were to go below this low, knowing that we have absolutely traded to the upside through it, so we offered what? Buy side. It's missing what? Sell side. So if it can manage to go below that, would you expect it to go below it a little bit and then shoot right back up real high? Or would you want to see it go below it and drift real slow and lethargic down to the previous settlement price? Or would you expect it to be, boom, one or two candles and get down to the previous settlement price? I would expect it to be quick and sudden to fill the gap. So it provides a means of classification on how price should deliver, not that this is where it could go. Well, that's one part of it. That's one part of the equation. But then you have to have elements of time, not calendar or clock time, but speed. How fast should a price run? How should a price run deliver? Should it be sudden, real quick? Or should it be lethargic and choppy and back and forth, lots of retracements? Or is it trying to get down there real quick? Now, I would expect if it were to trade below that low, to do it quickly. And what else is inside that area? That's today's new day opening gap. So we have a new day opening gap towards the low of the opening range gap and the remaining portion here. So we have to watch this low. What happens if it does this? Say it trades down below and starts to come back up a little bit. What is it doing? Well, it could be taking this wick right here, finding the midpoint of it, hit that, and then expand lower quickly. Quicker, like a sudden rush to get down there. Okay, so all of these things are very hard for me to articulate in chapters in a book, because there's so many instances where if I said that and I tried it, I typed it out, I looked at it, I asked, my friends say, look, when you read this, what do you get from that? He goes, I don't know what it means. And I was like, okay, so I have to do certain things in the live, like these things here, like in video. Whether I was doing this mentorship or not, I was going to be putting videos out to help support the trilogy of these books I'm getting ready to give to the community here. But there are some things that have to be communicated by a live medium where you can see it. It's not something that's like stilted. Like, here's a static chart. Here's a static depiction of what this thing looks like after it's panned out. That to me, I had a hard time learning that way. And I had no problems buying new books all the time. It just didn't really communicate it well. So when we sit over price action, a lot of you may not like how I'm teaching, but this is going to make much more sense to you when you start doing your own back testing and you have the notes of me talking about what it is that's important, what characteristics price should show and what should it not show. By having that foundation behind you, it supports not just simply the concept, but it supports the questions or concerns you'll have when you're watching it or trying to back test it. You'll think to yourself, yeah, but what about, and then you'll think, oh yeah, the note said that if it does this, this is what usually should happen. So if you have a question that comes to mind, and then you see that you've taken notes, and I've suggested to you that this is how it should book, this is how it should behave. These are things that you don't want to see happen, and these are the things that are supporting the idea. And as long as those things are there and they're supporting it, that means that you will grow confident that you have at least gone into that exercise, that drill, that back testing with the right mindset. And you're not trying to just go in and rush to get to trading. Because rushing to get to trading, whether it's with a funded account challenge or with a funded account, you got lucky to get there, or if it's real money, you're not trading with the insight and understanding that you should have if you do it correctly. And you can do it correctly and not take a lot of time, but you're always going to do farther in terms of the learning curve needing to be longer for you if you rush. And it's an oxymoron, really. You think you're saving yourself the time, but you're only increasing. And there it is again, one more time. How many times, man? How many times are you going to keep getting away with it? Damn it, ICT. Oh, I love it. Yeah, smoking yet? They've changed the algorithm. You hear that? They changed the algorithm and smart money traps. That's the thing now. That's the buzzwords. Smart money traps. Get the fuck out of here. You fucking love me. You know you love me. You say you hate me online. You leave shit in the comment section. Other people shit, but you love me. You love me. I know you do. So anyway, we have moved to the midpoint or consequent encroachment of that daily volume imbalance. That's that shaded area here, okay? So I want you to think about how you have been given, and I'm not done yet. Okay? Because we got a review yesterday and show you what you didn't understand. Show you some further proof that they've changed the algorithm. And they're targeting my concepts. They're not fucking targeting shit. You all that don't know how to use them properly, you're falling victim to ignorance, is what that is. It's no different than if you looked at a down closed candle and call that a demand zone. And you think that every down closed candle is a demand zone. And that's why people foolishly look at my stuff and they see, oh, it's a supply and demand. No, it ain't. Oh, no, it's not. All I got to do is go through the logic and study it. And it's not anything like it. You're looking at something because you want to be real quick so you can go out and talk, but you can't walk the walk. If you're coming out there with 50% strike rate and then coming away with, oh, well, it used to be you can make lots of money trading with 200R trades. They never took a 200R trade. That was the biggest bunch of bullshit. 200R, 150R, 100R, 80R, 50R. Everybody, what the fuck? Anybody with rudimentary math skills would know that if you're able to do that, here's the math. Ready? In 6.5 months, you're a fucking billionaire. A billionaire. But you're selling fucking Mickey Mouse mentorships. Get the fuck out of here. But they're jumping on the bandwagon because there's a lot of people out there impatient. They think it's easy. They think the person that's going to sell these things to them is going to make it easy and fast. And all they got to do is watch their bullshit, read their PDF. And they themselves have never done that shit they're trying to sell. They've never made a 200R fucking trade. They've never done that. They've never outlined it and fucking executed it where you fucking saw it. It didn't happen. It did not fucking happen. But I'm out here telling you every micro fluctuation, why it should, and giving you the data points. That way you can go forward, watch it going forward. And there's going to be an opening bell tomorrow. Next week, you got 5 more chances to do it again. You'll know right away if what I've said just today holds water or it doesn't. Think. Who are you going to believe? I'm not here to try to defend myself today. I don't need to defend myself. All I can do is look at what I'm doing. Look at what I already taught. Look at my students. Look at who they're attacking. That's all you have to do is see who's attacking. If ICT's in the title or if my logo's in their fucking thumbnail, chances are either they're a student and they're going through the process of learning how to do it themselves, or they're going to sell you something. They're going to sell you something. It's going to be an affiliate link. Use my affiliate link so I can make some fucking money because I'm broke as shit and I can't fucking make money trading. Hello. And then you have their own mentorships. Really? I don't know about you, okay? I understand the value of $1, even though I don't really care too much about price tags. I have a value on money. It holds a special interest to me. I don't love it, but I have an affinity for it. I sure as fuck am not going to go and sign up to somebody's mentorship where they talk like me. How do you know that they've gone through my mentorship, whether it was leaked or they paid for it? How do you know? They're going to say, this right here is mitigated. What the fuck? Mitigated. None of you even know what the fuck you're talking about when you're talking about mitigation. But every single Tom, Dick, and Harry mentor out there uses that word so much. And they don't even know what the fuck they're saying. They have no idea what they're saying. They think when the market returns back to an order block, it's mitigating. That's not fucking mitigation. That's not mitigation. What the fuck? It's redelivery. Okay? So that is what you're supposed to be saying. If you knew what the fuck you're doing, you wouldn't be calling it they're mitigating this order block. Every fucking Tom, Dick, and Harry mentor says it wrong. You are all fucking wrong. All of you are fucking wrong. You got it now? So if they're going to go through the pantomime of pretending they know how to do it themselves, I'm going to teach you better. I'm going to teach you faster. I'm going to shorten it. I'm going to simplify it for you. And they're using my vocabulary incorrectly. That right there disqualifies them because they have no idea what the fuck you're doing. No idea. Then add to it, the author is sitting here every single day explaining it the right way because Caleb is the recipient of it. Now, we trade up to the bottom of the opening range gap. That's the opening range gap below. We'll take that off of there. We don't need that. So, let me take a pause for a second. We're probably going to go to like 10:45 today. Okay? So just give me a little bit extra time. I know you're probably not complaining, but we were supposed to be done by 10:30, but I'm going to need a little bit of time to get into yesterday's discussion. But I want to cover what I did here and teaching and guiding you what to expect and how to use the opening range gap. If you remember, I gave you the lay of the land for the daily chart. Without me saying anything, what do you see in price action? What was offered as a premium array? Where did price repel from and move lower? And where did it go? ICT, you're scared. You're afraid to take a trade. You always do executions. You always do executions and recorded videos. And it's always the Indians. They're all from India. All of you guys must have like a big powwow together. Okay? And you're like, let's all go in ICT's comment section and say this about him. Because then he'll probably start doing it and we can copy him. I'm not going to do that for you. You're going to see me do executions in this mentorship. But I'm not going to do it as a steady diet. I don't need to do that. Okay? That level right there, the 20,001 level. Do you remember what that was? That's the rejection block, okay? If you go through the core content lessons in the 2016, 2017 mentorship, okay? I started that paid mentorship technically August of 2016. And I believe I introduced the rejection block in the 2016 portion of the lectures, but I don't recall exactly what lesson it was. But I think it's month 4. So you can look at month 4, 2016 mentorship. It's on the core content playlists on the YouTube channel for free. Go to the lesson. It's talking about rejection block. Okay. And I have this little line here. I explained to you why it was there. And also you understand that a rejection block can be used as a reversal pattern. That means if we have a high here, and we're expecting prices to do what? Gravitate where? Well, we have an opening range gap. So if it can trade to fill the gap, or make an attempt to do so, and we're up here, where should the price draw to? Down. Okay, wonderful. Where can it turn to start going down? Well, you have to know your PD arrays. Initial high, that's the opening range high. If it goes above that and spikes through it, which it could have done before it even did all this over here, It could have went up there and hit that wick of the high on the daily chart. Go back and look at how I walked you through the daily chart. It never traded there. So because it failed to get there on this initial run, here's the opening bell, runs up, next candle slightly higher, and starts going back down. Where is it going back below? The rejection block right there on the daily chart. That's the highest up close in that price swing on the daily chart. We failed to get to consequent encroachment of that wick. Is that bullish or bearish? When we have an opening gap, that's a premium. In other words, we had all of this. My mature students have been with me a lot more time. Their gears are turning right now. They're like, what the hell? This is amazing. I know. It gets better. But this opening and rally up and then going right back down below the low and below that rejection block, we couldn't get to the consequent encroachment of that wick. Well, that's intel. That's giving you what? I can't even reach up here for your ICT, so start looking lower. Okay. Well, let's wait for the market to do what? Give us the mid gap. Well, it does that. There goes the whole 70% of the time. It was one more time giving you the proof of it. In this leg here, and it starts to rally back up, it goes right above the rejection block. Go back and look at the lecture lessons. Listen to what I'm teaching there. This right here, that is a turtle soup. But you don't find that shit on Twitter, do you? Romeo, oh Romeo, tell me some bullshit. Sell me a course. Come on, turtle soup me. Come on, Romeo. You've been waiting for your fucking name. It's coming up today, boy. Your ass is on fire, ain't it? Shit fire, burn your ass. So, rejection block. It goes above it just enough to reject. Sends it lower, but there's no algorithm. Now, we're sell side, right below the initial low. That low also is just a little bounce off of the old volume imbalance. This ain't support and resistance, and it ain't supply and demand. And Elliott Wave ain't catching this wave. He's still on the beach waiting. This is not harmonic. It's not Wyckoff. It's good old ICT. So the sell side below here is going to draw to that. That right there, from rejection block to sell side, that may be your trade setup. That might be your cup of tea. That may be your magic bullet. I didn't say silver bullet. I said magic bullet, because they can form any time throughout the day, all day long. If you go through all this price action, okay, go through it. What do you see? 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 What is this? Oh, look at that. That right there. That is the very first fair value gap. Let's walk you through it now. Now, for some of you jokers that are here just for talking points to go in your circle jerks on Discord or Telegram or wherever you hang out on Facebook groups. Yeah, remember that time when ICD said this? I was watching, I forgot whose live stream it was. But I'm always watching I usually mute Patrick Whelan because he's really not saying anything important. I'm watching his chat. And one of his jokers in there saying, yeah, fun fact, ICT was bullish at the high. Actually, no, I wasn't. I was calling every individual level. And then when it turned, you would have had multiple partials anyway. And then I was already calling the lower one. So forget about all that. But folks will say, he's pointing at a fair value gap. And because price may go up to it or trade down to it, they think there's going to be an immediate response, because they don't understand there's an inversion aspect to a fair value gap. If we look at this, and some of you that are signing on to it right now, you're like, oh, this guy's talking hindsight again. You weren't here when we were walking through it. I said the very first fair value gap that forms between 9:30 and 10 during the opening range, because there is no 15-minute opening range, okay? I don't care that you pay $200 for a course. That is absolute horseshit. This is your very first fair value gap that actually runs up into a rejection block with an opening range that has not completely closed in. We did get the halfway of the gap delivered, offering what? Opportunity to see if it can retrace and go lower. If we go above, these are if and then statements, okay? For computer programmers, if you ever studied computer programming, it makes perfect sense. It provides you logic where you have a recipe. That's an algorithm. Algorithmic thought process is if this, then that. If this, then that. Or else, they're all programming statements, okay? And when we were trading here, I said, okay, we're at the top of the opening range gap. Once it trades above, it forces, if we trade below here, it will be a full gap closure. So you're watching price here. Now watch. Go back and listen to it when you can watch the recording. Rewind it and play this part over and over and over again. First fair value gap formed. There is no other fair value gap in here. There is no fair value gap in here. That one is it. Now, if that's your fair value gap, and we went back below the opening range gap high, as soon as we do that, that is indicative of what? Seeking that, where the sell side is. And if it's going to go there, it's going to be a full gap closure. If I was short, I would take partials just above the full gap closure. Why? Because sometimes the gap won't fully close, and then you can see it run and take out the relative equal highs. There's logic there. There's rules there. There's guidance, Kimmel. Okay? There's guidance here. There's rules. There's step-by-step processes. There's if, then, else, or statements. All these things have to be there. Just because I'm calling out a fair value gap on Twitter Spaces and price does this, oh, it failed because they're an idiot. If it goes back into the range, it's going to go here. If it's going to go here, it's going to be a gap closure event. So how will we use that fair value gap if that narrative and logic is in play? Wait for it to trade down below it, then trade back up into it. Then, what was I walking you through? How would you want to see price deliver if it takes out that low? Was I talking about that fucking high going up higher? No. No. How do you want to see price trade below that low? Remember, I told you I was going to be asking you questions. I want you to determine today, is there an algorithm or is there not an algorithm? Am I pulling shit out of my ass that has no point in matching it up with price action before it happens? Is there logic that's repeating? Are these statements in these PD arrays holding water? Is it validity behind it? Or is it just, I don't know what I'm doing. I'm looking for it to go higher, but it's dropping lower. Or I'm looking for it to go lower and it's going higher. Are you really seeing that? Because I don't believe that's the case. I gave you this low when we were in here. Do we want to see it trade slowly? Do we want to see it go below that low and retrace, go higher? Or do we want to see it trade below it and then accelerate down? Move quickly and a few candles going down. And I said, if it goes below that low, the style and the characteristic of that delivery should be sudden. It should be quick. I don't know, does that look like it's sudden and quick on your chart? Don't look at my chart, look at your chart. Even the lay people should be looking at that now, and you should be able to see it right about now or about to be forming. Caleb's probably watching that form now, or it had just formed. But all of you that have been watching the stream, you have the benefit of watching real time with 4-second delay what price was doing. Did you hear me waffle? Did you hear me, when it was dropping down there, did you hear me even get excited or hit a climax? Fuck no. My toes didn't even curl up. This is old shit to me. It's old. But some of you you're moist and wet now because you see this stuff working every single day in my hands in front of you. But you're not going to get to this level fast, and no one's going to get you there fast, okay? No one. They can't do this. Because if they could, they would do this. They want to help you, they will come out on YouTube and give their logic and their insights away for free. But they're selling you a mentorship. They're selling you a seat in a Discord. They're selling you something so they can pay their fucking bills, because they cannot do this shit in the real market. They can't do it. If the logic doesn't hold up with me walking you through it one candlestick at a time, not Al Brooks style, ICT style, okay? I ain't got nothing against that old guy, but this is not his shit. It's not his. And you can keep lining up everybody else. Keep doing it, because eventually it causes a buzz, and the people that watch these individuals, they come in and start watching my stuff, and they're like, wow, this is some shit. He's a little bit of a callous person. I don't like his language sometimes. He's a little bit arrogant. But wow, this shit really works. Good. That's really what the point is. I'm not here for friends. But you're seeing elements that prove to you they are not changing any fucking algorithm. There is no smart money traps. I literally walked you through it. I walked you through this morning. Where's the first fair value gap? There. Well, what do you do with the ICT? Oh, if it's above it and it's coming down, I'm going to buy it. Well, you don't know what you're talking about. And I've seen that. I've seen other live streamers that are supporting the things that I do, and they're trying to implement the stuff, but you don't know the logic. I was in a young man's live stream the other day. I subscribed just long enough to be able to comment. He put a trade on. It had no logic behind it. It was a little too premature. And I asked this, why there? And he went through the explanation. I told him, I said, annotate your breaker. He annotated the wrong one. And I didn't want to say anything because it would have been rude. But I went back in and I did a trade after leaving his stream using the breaker that he should have been using. And it was just like, took off. But the trade I did yesterday, I mentioned this many times in Twitter Spaces, and I mentioned it ad nauseum throughout mentorship when people were paying me to learn all this stuff here. These are not new PD arrays. They're the same PD arrays that I released and taught in month 4 of the 2016 mentorship. 2016, 2017 is all one mentorship. It was a 12-month mentorship. And I started it in September. I technically started teaching in August. And then in September, it became structured. So that was considered like month 1 content in 2016. And then month 2 was October 2016. It was 8 lessons. And then every single day I was live streaming. And I was doing these types of things. And because individuals were hoping it was going to be me calling trades, getting a stop placed for them, here's my targets. And I made them sign an agreement digitally through Adobe Sign, knowing that it wasn't a signal service, that we would be using a paper trading account as the medium. So that way it's not investment advice. I was protected. And I made them sign over indemnity. That means that there was nothing they could do to sue me, because everything they were doing was simply just me giving an opinion about price action. It's not investment advice. They signed that, and they couldn't be a part of it unless they did that. And they reaffirmed every single month they made a payment to me. They set it in a note. And if they didn't send that note with their payment, I refunded their payments until they sent it, or they just didn't continue. So every student that stayed with me has never came forward and said, ICT could not call these markets accurately. It's the opposite. And many of them still couldn't accept the fact that what I was giving them was the foundation of how they are going to learn how to do this. I can talk to you. I can sit out here and do trades, but that's not teaching you how to do it. You won't take every trade that I traded in front of you anyway, because some of you want to see it fail. So that means say, ha ha, look at this guy. I'm glad I didn't take his trade. I'm glad I faded him. You'll hear that shit. Oh, I took the opposite trade. You will show us. Record that you faded me. Record that. Show us why you were thinking that, Mr. Goldbach. This bullshit Goldbach stuff. I want to see the people live stream with it. Don't make a pre-recorded video and say, well, this is, I went against ICT. That's kind of like lowbrow trolling. Be a highbrow troller, okay? Top tier trolling would be, I'm going to go out here and live stream, and I'm going to say what I think is going to happen with the logic that's not my stuff, some other stuff. It could be something else. I'd love to watch it. I can take a good ribbing. I have a sense of humor, whether you realize it or not. I really do have a sense of humor. I don't have thin skin. I can take a good ribbing. because nothing anybody else is going to say about me is going to change what I already know, what I've already proven. And I've placed it in other people's hands. And you're learning how to do it. You're learning how to do it. And here's the Sibi high. So we traveled all the way down to the lower quadrant with the bodies of that old, should have been thrown away if you listened to everybody else, volume imbalance. Let's go back out just for a moment. Yeah, I'm probably going to need till 11 o'clock today. Honestly, I don't know how long we're going to go today, but I have to get it off my chest today. I knew it. I love it. Let's keep trolling him. He makes longer videos and teaches more. You're falling into my trap. That's not your trap. That's my trap. I'm looking for any excuse to get out here and talk for a long, long time. All right, so if we toggle this back, you can see that's the volume imbalance. And if we anchor a fib to that, you always want to do this on the time frame that the imbalances are forming. So now we have one with our quadrants, and I'm going to take that extension stuff off because, oh, no, I think that was me measuring that wick, isn't it? Yeah, that's what that is. So we'll take that off there. We don't need that now. The midpoint or consequent encroachment and the lower quadrant and upper quadrant is now toggled. This candle's low right here, the down close one with the long discount wick. That right there, that low is the high of this Sibi. All this one single candle to that. So in other words, you would see it like this labeled. If I was showing it to you with a naked chart, nothing else annotated, it would be me highlighting this area here. And it would look like this. Okay, and I would just extend it over. So we're seeing the high of that. So since price is above it and we're coming back down, that old array is what kind of array? It's a discount. The price is going to draw to it. It can draw to it. It can draw down to it, go through it, and come back up and treat it as what? A premium array. That's how you work through the PD array matrix that I teach in month 4 content on this YouTube channel in paid mentorship level teachings that I've given to you for free. And there's jokers out there selling them, and you're stupid when you pay for them because I've gifted it to the community. It's for free right on this YouTube channel. I got folks that are asking me, which mentorship should I do? And is one mentorship better than the other? You're going to have to go through all of them to get the full panoramic view. But any starting point, anywhere you start, just get started. But if I'm going to be doing this live right now over real-time price action, it's in my opinion that would be the easiest litmus test. Is there any value? Because if I'm not here live and I'm explaining something and it isn't working, or it's doing completely opposite to it, well, right away, you've saved yourself a great deal of time, right? Try doing that with your mentors. Have them go out there and spend hours every single day for free, giving you the invitation to say, if there's any real value to it. Because if there's no value, you can quickly save yourself time, energy, and heartache. You want to spend any more time, you'll never have to pay any money for it, and you go about your business and whatever. And anybody has an opinion that's contrary to me, then you can join their club. So, 1 minute chart. And here we have the quadrants, okay? And disregard, I know it's hard to do it, but disregard this new day opening gap for a moment, kind of like ignore it being there. We have the high of that shaded volume imbalance on the daily chart. This is the upper quadrant to it. Midpoint is this, there's consequent encroachment, it's red. And you have the lower quadrant level, and you have the low of it. We traded down, we created the fair value gap right there. And just above a new day opening gap for today. So what does that mean when we're down here? We can go above it. How far? Fill in the fair value gap. I like that because it's laying right on top of the upper quadrant. So are we looking at just a closing of a fair value gap? No. Are we looking for the market to trade right to the new day opening gap and just turn around like that? Because that's what some people have assumed. And they say, oh, new day opening gaps are trash. They go through them all the time. Again, that's the same logic that's going to be held by someone that puts a fucking YouTube video out and says, this is why you should not be trying to use SMC anymore. Because it's being targeted. Listen. If they have something to say about me personally or about my content, all they have to do is step forward and show what works and how this doesn't work. I'm open for it. I'm out here live streaming. I'm not going to stop live streaming because somebody or some other number of people come out and say, this is why ICT is wrong, and they start doing something. I would fucking love that. I want to have a Mount Carmel experience. Come on. Bring me your shit, Bale. I want to see it because I have everything to smoke all of you. I'll call down fire. Come on. I know he'll listen to me, but you're too afraid to come in here and put your stuff out there to the test. You won't do it. You won't do it because you'll have things that don't work. You'll say, well, that's the way because price is random. It ain't random. I've already proven enough that it ain't random. So if we have this fair value gap in the new day opening gap, we know that it can sweep above it. It need not just trade to it and drop down. No, that's not how it works. Where's the inefficiency? Right there. Do we have something in agreement with it? Just not by a fair value gap alone. What else is in close proximity to it? Inside that volume imbalance, that shaded area, the upper quadrant level's there. Where does it trade to? Boom. And then what does it do? Low, low. Low higher than that low. So what's below that? Sell side. Fair value gap closed? Yes. Bodies nowhere near closing on them, on that level. And where does it go? Down. Sell side. That might be your trade. That might be your silver bullet. Think about it. Roll it back. Let's say you saw this gap. And let's say you bought it because you're trying to figure out how to do this stuff, okay? You're tape reading. You're not buying it per se because you're trying to get a feel for what it is you're supposed to be doing. You're discovering your model, let's say. And say you say, okay, I'm going to try to buy this. And then it goes down and stops you out. Wonderful. That's a wonderful opportunity because then, because of the rules I just gave you, you know that we have a real strong chance that we're going to take this low out. And if it does, then we have even higher probability than the 70% that when we gap higher at the open, that the midpoint gap will be traded to between 9:30 and 10 o'clock. If it takes out that low, we have a 80% chance that it's going to have a 3/4 closure on the opening gap, opening range gap. So that means we're about right in here. So if it takes that low out, we can have that much of a range. So what happens when we start to rally back up and we see that inversion fair value gap? You already see it failed with your usage of you trying to buy it. And now it's tipped its hand to you. So what are you going to do? You're not going to beat yourself up and say, oh, this stuff doesn't work. You're going to say, okay, well, we went below it now. And the rules state that we went down half the gap, we hit that, and we rallied, but then we failed at the fair value gap. The very first fair value gap between 9:30 and 10 o'clock. Take a minute for a second. Take a second, okay? You have my permission to click on this right now at work, even if your boss is sitting next to you. Wink at Carl as you hit the thumbs up, because I'm giving you stuff that you have no excuse to be able to find setups in the first hour of trading. You have no excuse now. I've literally pulled back the veil and I've shown you rule-based ideas that are so specific. They're finite. If this, then that. If this, then this. Or if this goes below here, it's going to go back to 3/4, and then you wait to see if it gives you a full closure of the gap. And if it takes out the gap to the downside, which is what it does here, it trades below the low of the gap. Where's it going to trade to next? Well, in this leg here, is there any inefficiency? Fair value gap. Your eyes should jump right to it. What else is there? You can't just have that alone. Support it with something else. Upper quadrant of the volume imbalance. So now you have two things. So where's the liquidity at? If you're going to sell short in there, where's the liquidity? Where's the inefficiency first? Well, you have it right there. But that's not enough to get excited about. So if that's all you saw and you didn't factor liquidity below the lows, that wouldn't be a trade you would take on. But you have a low that's slightly higher than that one. It's too smooth. It needs to be made what? Jagged. Sell short. Engage the sell side. Be done. Be done. Because you've had now 1, 2, 3 legs lower seeking liquidity on the downside. So we've pressed 3 times into sell side. The market is entering, what we got, was it 1043? We're getting close to when the market can have a retracement into opposing liquidity. So we've seen sell off, and no buy side except for this one has been engaged in this. But we had 3 deliveries into sell side. So it's setting up a potential where we can get a intraday retracement. Even if it wants to keep going lower, it's fine. But you have to measure every single time we engage liquidity. If 3 times we go into sell side, or 3 times we attack 3 successive higher levels of buy side or 3 successive lowers of sell side, it opens and invites the opportunity for a retracement, for intermediate term retracement. It doesn't mean that you called the low of the day. It doesn't mean it's calling the high of the day. It just means that you need to be aware that you've done this now 3 times intraday. So it can spool the other direction. And many times that sets up a wonderful continuation to go even lower or even go higher.